State Farm and Farmers, the first and second largest property insurance companies in California, have stopped selling new home insurance policies in the state. And Allstate, the fourth largest property insurance company in California, has limited the number of new home insurance customers it will accept in California. To understand why this is happening, we need to go back in time 17 years. In 2006, California state lawmakers passed the Global Warming Solutions Act, which starts off by stating that global warming poses a serious threat to the economic well-being, public health, natural resources, and environment of California, with potential adverse impacts that include hotter, drier summers. Lawmakers used that assessment to justify imposing various fees and taxes on greenhouse gas emitters, but simultaneously they kept it illegal for home insurance companies to use climate change models when setting prices for premiums. Instead, insurance carriers that write policies which cover catastrophic fire damage are required to set their prices using a multi-year long-term average of catastrophic claims over at least the past 20 years. They cannot base prices on computer climate models that estimate forward-looking wildfire risk. That's problematic because the climate is changing, as evidenced by the steadily increasing number of acres burned by wildfires in the US each year. The number of acres burned by wildfire each year nowadays is roughly 3 to 4 times what it was in the 1980s. This plot shows just how big the gap is between reality and the California Insurance Code. It shows the total cumulative acres of U.S. federal wilderness land which have burned in wildfires since the start of 2002, that's the blue line, and compares it against what the total acres burned should have been if reality matched the 20-year historical moving average. And as a reminder, that 20-year historical moving average is the standard for how catastrophic insurance price premiums are required to be set according to regulations. That's the red line. The blue line being above the red line means that wildfires are affecting tens of millions of acres above what would have been expected from the historical 20-year average. And that's just land. What we really care about is money. Over 2 decades of cumulative underwriting profit were wiped out in 2017 and 2018, due in large part to a series of massively destructive fires. Those included the Thomas Fire in December of 2017, which destroyed over 1,000 structures and caused over $2.2 billion in property damage. The July 2018 Carr Fire, which destroyed 1,604 structures and caused more than $1.5 billion in property damage. The July 2018 Mendocino Complex Fire, which is actually a series of fires. The November 2018 Camp Fire, which destroyed almost 19,000 structures and caused over $16.5 billion in property damage. And that doesn't even include the most recent data from 2020 and 2021, which had even more intense fire seasons. August 2020, August Complex Fire, 935 structures destroyed. Also August 2020, the SCU Lightning Complex Fire, 222 structures destroyed. Also August 2022, the LNU Lightning Complex Fire, 1,500 structures destroyed. Also August 2022, the North Complex Fire, 2,500 structures destroyed. The September 2022 Creek Fire, July 2021 River Complex Fire, July 2021 Dixie Fire. State Farm alone recorded an underwriting loss of $13.2 billion in 2022, and yet California lawmakers and insurance regulators claim no responsibility for the company pulling out of the state. Quote from the California Department of Insurance: "The factors driving State Farm's decision to stop writing new policies in California are beyond our control, including climate change." You heard that, right? The California Department of Insurance knows that climate change is massively increasing wildfire risk and hurting insurance companies. Yet, they won't let insurance carriers price in that risk. It's ironic, actually. California has one of the highest exposures to increasing climate change risk of any state, due to its size and geography. But the California Insurance Commissioner has barely approved any rate increases in the last decade. Take a look at this table. The average homeowners insurance premium in the US went up by 37.4% between 2010 and 2018. But in that same period of time, the average homeowners insurance premium in California went up by only 14.3%. It's about 2.5 times less, despite the risk increasing more. Now, the immediate solution to the insurance crisis is actually simple, and it's a solution that the banking industry already adopted years ago in response to the financial crisis: forward looking risk estimates. Like the insurance industry, the banking industry used to estimate credit risk, that's the risk of someone defaulting on a loan, based on historical data. However, after the financial crisis, bank regulators started to think that perhaps banks should be a bit more forward looking in how they estimate credit risk. Bank regulators eventually mandated a new framework called CECL, which stands for Current Expected Credit Losses. CECL is the amount of money a bank expects to lose based not only on historical data, but also on future projections that account for possible changes in macroeconomic conditions. Now, CECL is actually still being rolled out, which is why it didn't necessarily have a huge impact on situations like Silicon Valley Bank's collapse or First Republic. But in general, it does make banks more conservative, and it does allow them to be more financially viable. The insurance industry needs something analogous, which I call CEPL, Current Expected Property Losses. California's insurance regulators need to pass new rules that allow property insurance carriers to set the price of premiums based on forward-looking current expectations of future property losses, which might differ from historical trends based on changing climate conditions. Now, if you want to help reduce climate change, make more money, and hear a baby laugh, then hit the like button.